So what exactly is a stock? I know we've talked a lot lately about investing in the stock market and buying stocks, but what exactly does that mean? So in this video we're going to get into maybe the definition of what a stock is, how a stock trades, what it means to own a stock. So a stock represents ownership or an ownership share in a company. So if you go out and you buy a stock, you own a piece of that company. And of course, depending on how many shares of stock you buy, this represents a larger or smaller portion of the company that you own. So let's talk about what it means to buy and sell shares of stock from both perspectives of the company as well as the investor. So when a company sells shares for the very first time, what they're doing is raising capital so that they can invest and grow their business. And this takes place in what's called an initial public offering, or an IPO. Now maybe you've heard of an IPO before, but you never really understood what IPO means, or it just sounded a little foreign to you. Well, IPO is literally the letters I, P, and O, and it stands for initial public offering. So what happens or what takes place during an initial public offering? So let's look at an example. Let's say that I'm Company Clay, and I want to raise money or raise capital through the issuance of shares. So what I do, I fill out a bunch of paperwork and go through all that stuff, but at the end of the day, I sell shares or ownership in my company. Now let's say that you, as an investor, want to buy a share. And let's keep it very simple. I sell you a share for $10. This is the initial public offering. You give me the $10. Now, I'm able to use this money, I'm able to reinvest it in the business, I'm able to help grow the business. Maybe it doesn't matter what I need it for, but this money is going towards the business. So you spent $10, now I have that $10, and you have partial ownership of the company. Now, what are you expecting as the investor? It could be a variety of things. I could pay a dividend with the net earnings or the net profit that's left over at the end of the year. Or Company Clay could increase in size and increase in worth because we took that $10 and we were able to grow the business with it. So now your original $10 investment, that share of stock you hold, somebody else is willing to pay $11 for it because the business is growing and the business is profitable and it's doing well. I wasn't able to grow the business without your $10, and your $10 is now worth more because of what we were able to do with it. So from the perspective of the investor, you're putting your money to work for you. All you're doing is setting out the capital in hopes and expectance to gain more at some point in the future, whether that's through passive income such as dividends, or that's through capital appreciation with the stock's price rising. And from the perspective of the company or Company Clay, we bring in that money, we're able to invest and grow our business. Now there's two different types of shares that an investor can buy and a company can sell: preferred shares and common stock. So let's look at the major differences between the two. Preferred shares are a lot less volatile. And like their name says, if the company ever goes bankrupt, preferred share owners are among the first in line to, I don't want to say benefit from liquidation, because of course nobody benefits in the case of a bankruptcy, but they're the first ones to be paid back in the instance of bankruptcy. Now, what should they get in return? They should receive a very healthy dividend in return for that. There's not much capital appreciation and not much volatility in the price of the stock, but they are given a very safe and a very healthy dividend. Now, common stock, on the other hand, is noted by the voting rights that each share has. So if you own common stock, you own a piece of that company, but you also have voting rights so that you can help determine the course of the future of that company. So preferred shares do not have voting rights, while common shares do. And although preferred shares carry a very healthy dividend, common stock is not required to. It's not required to pay a dividend at all. The dividend can be determined by factors that are going on with the company, net profit, and so on and so forth. But common stock investors are always looking for capital appreciation. There is absolutely zero limit on how high a common stock can go. So for example, if you bought that $10 that $10 share from Company Clay through the initial public offering, there's no ceiling that $10 share is going to hit. It can go to it can go to $11. It can go to $20. It can go to $10,000. There's nothing to say how high that share can go, except for who's willing to buy it and how much they're willing to pay. So now that we know what kind of shares are available and maybe what exactly a initial public offering means, let's look at some factors that influence stock prices or influence the price of the stock market. There's internal factors such as earnings, management within the company, revenue, stuff like that. There's external factors such as economic releases, GDP within the country, overall inflation within the country, things such as this. Political impact has a lot to do, or can have a lot to do, with the price of the stock and the price of the stock market. For example, I know that when marijuana was legalized in Canada not too long ago, marijuana stocks shot through the roof. We've seen the impact that diseases and such can have on stock prices and stock markets too. If you take a look at the COVID-19 and the coronavirus and the impact that it's had on the economy, on the stock market, on stock prices, what happened when people started to realize exactly how bad this pandemic was? Stock prices plummeted. So we know that there are a lot of external factors that really push down and such. But three of the main factors that drive stock prices are earnings, inflation, and interest rates. VectorVest teaches all about these, and it's very important to keep in mind when valuing a stock. Now, at the end of the day, what drives stock prices is supply and demand. And of course, all of these other factors that I just mentioned affect supply and demand, but it's supply and demand that affect the stock price. If earnings are going down, this could adversely affect demand, so demand will go down. So we've seen how demand can affect the stock's price, and it's the same thing for supply. If we have an oversupply, of course the price should go down because there's too much of the product available. So a quick recap. A stock is a percent or a partial ownership in a company. When you buy a stock, you become the shareholder or the stakeholder in that company. Common stock gives you voting rights. Preferred stock gives you a healthier and more steady dividend. So depending on what type of investor you are, if you're looking for capital appreciation or if you're looking for passive income, these are two things to consider when determining what type of stock you want to buy. So hopefully you guys have a little bit better understanding about what exactly a stock is. And in the next video, we're going to talk about what exactly the stock market is. You know, how does it work? How are you able to place trades? What does it mean to buy a stock on the stock market and then trade it to somebody else afterwards? So if that sounds interesting to you, I hope that you guys stay tuned for the next video. If you're not a part of the VV Nation already, please don't forget to click that subscribe button, join us, give this video a like, share it with your friends, and as always guys, I hope you have a great day. So if you liked that video and you're not yet a part of the VV Nation, please don't forget to click on the subscribe button below, or you can also subscribe to the channel by clicking here. And if you want to skip around a little bit, or if you want to watch the next video in the series, please click the video right here.